The broadcast is now starting. All attendees are in listen-only mode.
Hello everyone, and thank you very much for taking time out of your day to spend with us here. My name is Matt Alina. I'm one of the marketing guys here at URL Insurance Group, and this week is week number 2 of the Index Universal Life Boot Camp series that we're hosting with our friends and partners at North American Company. Last week, if you joined us, we were just basically talking about the mechanics. How does an Index Universal Life policy work? And how does it build some cash values and just some of the nuts and bolts of an Index Universal Life policy? That was in week number 1. In week number 2, which is this week, we're going to be discussing how insurance companies cover index credits. A lot of insurance agents, when they're showing an illustration to a client, they show the client that there is a potential for a cash value. How does that cash value get there? Well, we're going to discuss that and give you the inside details, inside scoop on how that works. So this is week number 2 of the 5-week series on Index Universal Life Boot Camp. Just a quick introduction for those of you that are new to URL. First of all, welcome, and thank you again for taking time out of your day to join us. I just wanted to introduce you to our Life Markets team. We're headed by our Vice President of Life Markets, Steve Clemens. My name is Matt Alina. I'm an Agent Support Specialist here, and Joey Fry is also an Agent Support Specialist. Steve, myself, and Joey, we're here to help you with any life illustrations, any marketing support that we can offer you when you're getting ready to make a presentation to your client. Once you have submitted an application, your case managers, Rosemary Evans and Rachel Cook, will be taking over. Rosemary Evans helps agents with last names A through L. Rachel Cook takes care of the agents with last names M through Z. Any licensing questions, you would want to contact Judy Warner, and she's at extension 109. Our toll-free number, by the way, is 800-WANT-URL, and that breaks down to 800-926-8875. You can also find us on the web at urlinsgroup.com. For agents that are doing business with us already, you already have your own username and password that is exclusive to you. But for those of you that are new to URL, feel free to kind of take a look at what we're all about, see what we offer. Not only do we do life insurance, but we do annuities, and we do Medicare supplements, Medicare Advantage. We do single premium life plans. We do a whole host of things. It's easier to say we don't do P&C and securities. But feel free to use our temporary username, which is Gemini, and our temporary password is Partners. And I also want to talk briefly about our Gemini program. Our Gemini program is actually a partnership program on steroids. It is a way for you to get exclusive quarterly bonuses, exclusive leads. We'll also be providing some different new business technology. There's going to be free E&O. And this program is going on right now. All you need to do is apply, and we'll also have annual retreats and other networking events. And it's, like I said, it's a partnership program on steroids. And for more information, feel free to contact any of us here. We'll be happy to discuss that program and how it benefits you and your business. So again, today is week number 2, and it's going to be discussing how insurance companies cover index credits. How does the cash value get inside those life insurance policies on an Index Universal Life plan? And our drill instructor and our partner and friend is Kim Grund from North American Company. Kim, thank you very much, and I'm going to hand the controls over to you.
Okay, thank you, Matt. Welcome, everyone. We're going to get started here in just a second. Okay, as Matt indicated, the title of our presentation today is Demystifying Index Universal Life and How Insurance Companies Provide Index Credits. As Matt indicated, I'm Kim Grund. I'm the dedicated internal marketer here, working with longtime partner agency, URL, just a fantastic partner with North American. So with that, we'll get started. This is our disclosure page, and this does apply to our entire presentation. This is what our agenda looks like today. First, we're going to address how life insurance companies can afford to credit interest rates based upon an index with a 0% floor. Then we're going to talk a little bit about why cap or participation rates move. Then a little bit about variable interest rate loans and how companies can afford that design. And then we're going to wrap it up with just a little better understanding of the differences between index annuities and index life. So the premium dollars that a client pays, they're invested in the company's portfolio. And typically, this is generally high-quality bonds. Bonds provide us a relatively stable and expected rate of return. But you might ask, how does a company then afford to credit interest rates that could be significantly higher than the bond returns that they are getting? The answer to that is generally call options in the underlying index. So essentially, interest from the bonds are used to buy options. So we're going to take a little deeper look at call options. What a call option is, it's a vehicle. It pays off when the underlying index goes up. So say if the index rises 10%, the call option pays off, and that's going to help the company provide the index credits. If the index value decreases, the call option doesn't pay anything, and the company doesn't credit anything. Call options, however, they've got an unlimited upside. So you might ask, does the company make extra profits when the index growth exceeds that index cap rate? Generally, no. The company, we're not seeking to have either profits or loss from the movement of the index. And we generally sell options at the cap rate to effectively result in an option that pays off for positive index returns up to our cap rate. Options aren't the only way that a company can afford to provide index credits. The use of options, it's generally referred to what we call static hedging. But a company could also use elements of what we call dynamic hedging, where we may do our own hedging of the index without entirely resorting to outside purchased options. Either way, basically the focus of the life insurance company is to seek revenue, just to be revenue neutral from the index. The design goal is minimal exposure to either profits or loss from either a negative or a positive performance of that underlying index. So here's a little flow chart of the process. Client pays a premium. Like I said, most money is invested in the bond portfolio. As a company, we buy options. Then the index performance is going to determine if options pay out, and then the company credits the applicable interest. Two most significant factors affecting either the cap or the participation rates are the option budget and also the option prices. Our option budget, it's determined by the company's portfolio returns along with any charges in the product design, which may also help provide a boost to the option budget. So, for example, if the company achieves, say, a 5% portfolio return, possibly 1 percentage point is set aside for costs and company profits, and that's leaving 4% to spend on options. The company also might have some additional charges in the policy to help supplement an option budget. 50 basis points, for example, could help provide a larger option budget, which in turn can result in larger caps or par rates. But because of the different investment returns and product design, companies may have significantly different caps and participation rates. The other factor that impacts caps or par rates, it's the option price. Option prices, they're basically a free market item, which the company can't control. So if option prices are more expensive, the cap or participation rate may need to fall. If option prices are less expensive, then we may raise our cap or participation rate. Because of these two factors, they can change over time. Index life insurance needs to have at least one moving element to accommodate for these dynamics. Either the cap rate or the participation rate will be adjustable in each index life product. And prior to the session today, I did send some brochures over to Matt, and I think he'll follow up and send them to you. We've got all our current IUL cap and par rates, and also the guarantee rates on those brochures as well as some historical information that I think will be helpful for you. We're going to talk a little bit about variable interest rate loans. They're a type of participation loan where the client can actually still get index credits even on funds that have been borrowed against. A lot of times we get the question, how is this possible? How can the client get index interest on money that isn't in the policy? And first of all, just to realize that policy loans are different than withdrawals. Withdrawal is actually removing the money from a policy. A loan is different in the sense that the money is still in the policy earning interest, though it's being used as collateral to back the outstanding loan. So as long as the company is charging an interest rate on the loan that compares to the interest rate they would have received in an investment bond fund, there's no reason why they can't credit interest as they normally would. And you might ask, so why a variable interest rate loan? Can't the company just charge a static loan rate? The company could charge a fixed rate, but that leaves some exposure to the company. Do you charge a low rate that might be attractive to the company but have potential profit concerns later if interest rates rise and loans have opportunity cost? Or do you just charge a higher rate that is less attractive to the client but safe for the company? So one of the ways to achieve a competitive loan rate and still protect the pricing integrity of the product is through variable interest rate loans. If the free market rate of return, and this is indicated by the Moody's corporate bond rate, is low, then the variable interest rate loan rate will be low. If the bond rate rises, then the variable interest rate loan will rise. So a variable interest rate loan, it's going to allow rates to be as low as possible in low interest rate environments and still meeting the company's pricing goals. So the cap on North American's variable interest rate loan, it's 6%. However, right now, anybody that's got a policy that's taking out a variable interest rate loan, we're only charging 4% because we're in a real low interest rate environment. For illustration purposes, however, we're illustrating a 25-year look back, so we're illustrating a 5.47%. Like I said, many variable interest rate loans do have a cap on them. Like I said, our current rate is 4%, could be 5% with other companies. Cap might be present on the variable interest rate loan as 6%. And this is going to protect our clients from a runaway loan interest rate. So a capped variable interest rate loan will provide an element of client comfort compared to an uncapped loan. Of course, a loan cap costs money if interest rates rise above that cap rate, which could affect the ability of the company to raise the cap rates as high as they otherwise could be in a rising interest rate environment. A fixed rate participating loan could have these pressures significantly sooner than, say, our variable interest rate loan. Shifting gears a little bit, another question that comes up often about index life pricing, it's why are annuities and life so different on their cap and par rates? One difference is really the nature of the product. Annuities, they're generally short-term. They're very focused on interest rates. Also, annuity rates are new money rates. They respond quickly to either a rise or a fall in the bond returns. Life insurance, this is generally longer term. It's priced upon portfolio rates, and they're much slower to move and generally more stable. So because of that difference, the annuity cap and par rate may be a little bit more volatile than life insurance. Also, they're going to be quicker to respond up or down in rising or falling interest rate environments. The other factor that's important is the option budget. Annuity companies generally make money one way, and it's going to be that spread in the interest rate that they earn and then what they credit. So Life insurance companies, we can design products with a little bit more flexibility to include other charges and maybe take smaller interest rate spreads. So because of that, annuities might have less money to spend on options than, say, a life insurance product, even if the bond rates are similar. So that pretty much summarizes our presentation today. It was pretty short. We did give you a summary here. We provided, gave you providing index crediting. We talked about, how we buy on, purchase bonds and invest in options. We talked about the cap and participation rate, kind of adjusting for the unknown. Also talked about our variable interest rate in North American. They are capped at 6%. Like I said, currently we're charging 4%. And then we talked a little bit about the difference between the pricing on annuities versus life insurance. So that pretty much concludes the presentation. I'll turn it back to you, Matt, to see if we have any questions.
That was short and sweet.
It was.
If anybody has any questions, feel free to either type your question and I'll read them aloud, or you can raise your hand and I will be happy to unmute your phone or your microphone, and you can ask your question aloud as well.